Welcome everyone to Module 1, which will be focusing on debt and debt sustainability. This is one of the most important core components of the three-part course that we will be having in the coming weeks. I will provide some general latest information with regards to debt and debt sustainability before going to some background information and the economics behind it, and going directly into some of the key recent data sets and also the composition of debt that African countries are facing. Within this slide, the following are very, very important because the three top priorities of African policymakers right now is to have an orderly management of the existing debt stock, which is accumulating to unsustainable levels. Let's be honest, the plain truth is that debt in Africa is unsustainable. So debt is one key problem. And the volatility of commodity prices and the economic as well as the health consequences of the COVID-19 pandemic. After the troubling 2020, last year, GDP growth is expected to be positive this year for Africa on average. This is according to the latest African Economic Outlook, which was launched in March, as I was explaining when we were recording Module 0 last week. Now, if you compare the forecast or the positive forecast of 3.4 GDP growth in 2020 with 2020, it is quite stark. It is quite the worst year for many, many economies globally. And therefore, Africa was growing at negative 2.1%. But now we are on a positive trajectory, even if there are a lot of some depressing news coming about third waves of COVID pandemic in the European continent, which might filter into other places. However, the pandemic accelerated the debt problem that we have already in Africa, and the debt to GDP ratio is expected to rise. In 2020, during the pandemic, it was 60%, but now it's expected that it is going to rise by at least 10 to 15% more than 60%, which takes us to the range of 70 to 75% of GDP. And this is extremely worrying, particularly for Africa, which has limited access to capital markets. Fiscal deficit in the continent is doubling, so fiscal space is just decimated. If you read the third chapter of the latest, the 2021 African Economic Outlook, on commodity prices and debt repayments, you will find more charts, figures, and also evidence on debt and its sustainability, because the African Economic Outlook, the core theme of the report itself is debt and how we can get out of debt on the road to recovery after the COVID pandemic. One of the big problems when it comes to debt is how you can resolve it, because there is no way back now. We have accumulated debt, and this should be handled very sensitively in consultation with all stakeholders, private creditors, bilateral lenders, and multilateral lenders. And this is very, very complicated because they have their own specific different interests, as opposed to the interest of Africa in terms of resolving it. Therefore, bringing them into the table and having an internationally agreed financial architecture, which can really be debtor-friendly, is the most challenging aspect of debt resolution that we have witnessed since the 1970s. And now, because of the composition of our debt is changing, it is more complicated because the power of the private creditors is more and more strong now. So it is complicated due to the changing nature of the composition. The From the African side, the debt transparency is low, and particularly this is due to non-concessional commercial loans, but at the same time, with some tricky bilateral lenders, which are really regarded to be not having the best interests of Africa, but at the same time, African governments also make those bilateral deals and they don't reveal the full extent of the debt and the debt obligations that they have. In the meantime, there are a lot of drastic, radical, and bold steps that African countries should really be considering, but for sure in coordination and cooperation with the international community and stakeholders who have a stake in this accumulating debt. Easier said than done, but there are solutions: restructuring and rescheduling, including the payments, and also sometimes forgiving a portion of it, so reduce illicit financial flows from the top continent. That is being pushed at a policy level, at a high level, for almost 5-6 years now, if I remember very well, including the latest report that just came out in January. There are options such as improving public finance management, getting our public finance in order within our borders. And this usually helps us to restructure our debt because it shows our commitment. And it also helps us not to have debt to unsustainable levels. So we have to cut the excesses and we have to manage what we have efficiently. Improve governance, accountability, and debt transparency. Still, this is being demanded by all stakeholders, particularly those who were requested to renegotiate, restructure, and reschedule debt. And international cooperation, as I told you, not encouraging. And history tells us these negotiations are usually favoring creditors. Therefore, we will usually be on the losing end. At the same time, if we are saddled with huge debt, our negotiating power is diminished because we might accept some reforms, some conditions, just to be able to have a breathing space when we are overwhelmed by huge debts. There are some other actions, for instance, in terms of improving or making some headway with regards to collecting more revenue in the form of establishing new taxes and also pushing taxes in the right way to individuals who should really pay it. There are a lot of political concerns when it comes to some taxes, such as property tax. But under the pandemic, there are some countries which took very brave and courageous actions, like Sierra Leone. So property tax, even if it is politically sensitive and usually it favors the poor, but not favors the political elite. Therefore, the political elite should really consider raising some revenue from those who should really pay it. So a property tax is one. There are technical problems with regards to valuation of property, but barring that, still it is an option for raising revenues. And there are also non-tax revenue sources that Africa can really capitalize on. Usually when we say DRM or domestic resource mobilization, everybody says, oh, tax to GDP ratio. I think we should also consider non-tax revenues in the form of endowments and also natural resource rents, and also to be brave to renegotiate our mineral contracts with multinational companies and make sure that we have the right royalty payments that should stay in Africa. We are really disregarding that very, very important component of the public finance when it comes to DRM. I wrote a background paper on non-tax revenue, and we will discuss that under module 2. Other actions include leveraging and be wise and prudent in terms of using proceeds of increased commodity prices. Now the oil price is rising, therefore there are some proceeds which we should really put to good use for rainy days. So therefore we have to manage our natural resources better too. Digitization, a very useful transformational tool for our economies to take advantage of some policy modalities agreed, such as AFCFTA. The debt problem, even if we are studying this fiscal policy in the context of COVID, I want to underscore that the debt problem is not new. We have witnessed it for centuries, and particularly in the 20s and the 21st century, that is really famous, particularly since dual crisis or oil crisis in the 1970s and 80s. The New York Times article had the following statement in it in 2004. Sub-Saharan Africa actually is just really not being dealt fairly because it pays $1.3 per $1 it gets in the form of aid. And this is basically because of the repayments in the form of the principal and servicing of debt interest rate. Therefore, Africa is really losing a lot of money through debt servicing. In the meeting that I attended a few days ago on the launch of the African Economic Outlook virtually, Joseph Stiglitz said the following: poor governments have very limited fiscal space. But at the same time, the creditors, particularly the private creditors, want to squeeze a lot of funds out of the poor countries. Even under the context of COVID, when there was campaign to reschedule, restructure, and reduce, and also give some repayment holidays for poor countries, there was huge resistance from major advanced economies, for sure, the private creditors. And he simply said, you cannot squeeze water out of a stone, which is to say that it is unfair to really push the debt onto, or the repayments onto Africa. It doesn't mean that we should encourage forgiveness and also debt excesses of some governments, but there should be some form of international cooperation, coordination, and fair resolution of the existing debt. We cannot really escape it. I will just be quick on the need for external finance. You have studied economics at advanced levels, therefore I just want to keep it's very simple and why we need external finance, for instance. It's because we don't really manage our current account balances and capital account balances well. The net capital flows and trade balance is explained in the form of the following: the balance of payment, or BOP equation. So a balanced balance of payments is given with a sum of current account and capital account. X standing for exports, M imports, I investment, S savings. If investment is less than savings, you will have a capital account deficit. And usually this is financed by a current account surplus if your exports are greater than imports. On the other side of the coin, if investment is greater than savings, your capital account will be in surplus, which is good. But usually we have a trade deficit because we have more exports than we have more imports than exports. In that case, the current account, the capital account surplus will cover the deficit that is coming from the trade side. But if you face both capital account deficit and trade account deficit, it is stark, and usually this is the reality of many African countries. Then external finance is very, very important to manage the balance of payments. So the current account deficits must be paid off with a corresponding capital account surplus. If not, you have to have foreign direct investment. And this declined after COVID because we are studying these inflows and outflows from advanced economies in the context of COVID. and we need financial aid flows. And if the grant element of aid is not substantial, countries in Africa suffer. And this is the case when it comes to more aid being that important in the aid package. And we have to also run down our decimated foreign exchange reserves. And we have to borrow. We have to borrow from abroad, and at very, very expensive prices. And as I told you, some countries are being downgraded by major rating agencies. Therefore, it is becoming expensive. So even if borrowing is an option, it is expensive. And for some, it is not even an option from the capital markets because of the poor rating, they will not be creditworthy. And if some creditors want to lend you, they will really ask very, very high interest rates. So short-term external finance may help avoid macroeconomic disruption and promote growth. And this is really usually keenly felt when we have major shocks such as the COVID pandemic. And the long-term borrowing to cover permanent current account deficits must be invested in projects which are bankable. And this is where usually we are being challenged, because if a development bank of a given country is given a loan from the fund, for instance, it should really invest it in a bankable project which enables the country to repay it. That's why we have a tradition of really failed development banks, because the way projects are screened, the way projects are monitored, the way they are followed up, the way the feasibility studies are checked, and even the way the development banks are staffed with skilled manpower is very, very important. So there are a lot of homeworks internally within Africa that we should do, but at the same time, if we want to get out of this revolving door of debt repayments and also huge debt, I think the long-term borrowing should be invested in infrastructure projects, for instance, which can be useful for private as well as public sector. The gains from external finance must be as great as large as the costs of debt servicing. That's why when you are studying, or even for your research, if you are doing some econometric work, it's useful to work with not only debt to GDP ratio, it is better to work with debt to external exports earnings ratio, because that is really a good indicator of the ability to pay, because that is where we get the foreign exchange. In all this, prudent public finance management is critical, and COVID-19 is a wake-up call for some carelessness, particularly for those who took excess loans. Wise investments are needed, and this was directly addressed in one of the fiscal monitors of the IMF in 2016. Therefore, that's why I was saying the debt is an old problem. It is not just created by COVID. So we shouldn't really be surprised there. The duration of the loans should be matched to the time needed to realize the investment benefits. So when we discuss our loan contracts, the investment plan on our side should also be there with the timeline. Accumulating debt to finance consumption or government expenditure increases future debt, but we cannot avoid that. But at the same time, this should be balanced with what we can really generate out of the money borrowed as well. External finance used for covering adverse effects of economic mismanagement or war, long-term growth will suffer. Yeah, I think you know what is happening in some countries as their military expenditure is very, very expensive, because warfare in the past is very different from warfare today. Now, warfare materials are very, very expensive. Therefore, many countries will really incur a lot of bills on military expenditure, and defense departments are the most secretive. Therefore, that relates to the debt transparency point that I mentioned. I don't think we will get to the bottom of the volume of debts that countries amassed due to military expenditure. And that is one key element which compromises our long-term growth, and which also condemns us to this cycle of debt all the time. There is a brief note by Gahatak, who wrote it in his Monetary Economics in Developing Countries book, which compares the cost of default with the benefit of repayment. And this is really actually a decision that some countries arrive at when they're really at a breaking point, like Zambia. And even Ethiopia is going in that direction, my own country. So the risk of being downgraded is a cost. Not only that, there is a direct cost of being downgraded because it will reflect on higher interest payments and also being denied of any access to capital markets. And the benefit is you just offloading the responsibility. So the costs and benefits should always be compared at least at theoretical level. If the default benefits 1, they go for it. Therefore, if B is greater than C, that's what they do. Krugman and Dobsfeld in 1988, they let the benefits of default equal the resource transfer or the cost of repayment from the debtor country to its creditors. Therefore, that is the money that can be channeled to something else. And within a 5 years or within a 10-year period, if the country has really benefited from that forced forgiveness, because the creditors are not forgiving when the country defaults, but if we interpret that as a forced forgiveness, and if the country shows for it through long-term development and wise investments, because it is no longer paying because it defaulted, that will be amazing. But that is not seen in history very well. Rather, once countries start defaulting, they seem to have a habit of notoriety and default again. Maybe you are well aware of the history of Argentina, which is one of the countries which tends to really to default options quite quickly. So I will leave it to you when you are reading the notes and the slides to read a little bit more on the repayment options and when to pay and when not to pay. Actually, defaulting is not what we encourage. And some of the fundamentals that we know from debt economics is that we have the Laffer curve, we have the expected debt repayment mapped into the debt stock. On the horizontal axis, the debt stock just keeps accumulating as we move from left to right. And after a certain point, the expected debt repayment will be too much and the debt repayment starts to fall. And when the weight of the debt accumulation is excessive, we will be on the wrong side of the debt Laffer curve, meaning immediately after the maximum point of this bell-shaped curve or the Laffer curve, once you start on the right-hand side of this curve, you are on the wrong side of the Laffer curve. And many countries will experience these large debt stocks and the probability of paying is low for those countries which are really on the wrong side of the debt Laffer curve. And this is what is being mapped against each and every country. For instance, if you read any of the debt sustainability documents of the IMF currently, countries are classified as low risk, medium risk, high risk, and of distress. And usually most of them are on the wrong side of the Laffer curve, therefore they are populating the right-hand side of this curve that we see. And this is where the different scenarios of repayment are being negotiated and discussed and also being used as an alarm. And it is very alarming. And I feel many countries are feeling large debt stocks, and they're in the debt overhang state in Africa. Even those who were growing at a very, very good rate of economic development. As you can see, the debt trajectory, the debt problem started immediately after a slight recovery following the 2008-2009 financial crisis. So public debt trends for sub-Saharan Africa, a simple average, median, any indicator of central tendency that you might use or percentile that you might use indicates that it is increasing even before COVID. And IMF in 2020 and the World Bank have this curve or chart which shows a ballooning debt for almost a period of 50 years for Africa, but it is getting worse after 2010. So again, this trajectory is consistent with the trajectory that I showed you in the previous slide. So during the past decade, total debt in emerging markets and developing economies rose to historic peak, and Africa is part of that. So these aggregates are computed using current levels of total private and government debt as a percentage of GDP. What about the debt composition? If you look at some countries, Mozambique, Ghana, Zambia, Senegal, Ethiopia, Madagascar, Angola, and Kenya, if you see a clay color, brown, orange, all these are private creditor loans. And some of them based on issuance of the Eurobonds like Zambia did, and Zambia already has defaulted. So Zambia, even if the debt service to GDP ratio is low in the last few years before it defaulted, but it was showing that the proportion of private credit and commercial bank credit is getting much higher than bilateral public or multilateral public debt. So it just simply shows that there are differences in the, or changes, radical changes in the composition of debt. Ghana is also one country which is managing so far well, but it might also succumb to the debt accumulation and the unsustainability of debt. And Ethiopia is one. And it has been downgraded by Fitch ratings and the Standard & Poor's as well. Okay, the excess of debt and poor growth, for sure. The more debt problems that you have, the output growth, as it was indicated, is declining. That's why many empirical work is inspired to examine the link between total debt or external debt and growth, either in an endogenous growth model context and collecting data from many countries over many, many decades and looking into the relationship more analytically and rigorously. And you can do that using modeling options such as the generalized method of moments by running a regression of GDP growth as a function of many of its determinants, including total debt on the right-hand side. And debt of today depends on debt of yesterday. Therefore, you can also make the regression equation or the econometric setup in the form of relationship between output and debt dynamic. And in that case, you can use what we call the generalized method of moments, the system GMM estimator, and you can say something more concrete in terms of the actual impact of debt on economic growth. And it will not be surprising if it is not, if it is negative. Okay, these are some forecasts from IMF on debt to GDP ratios. And as you can imagine, for some few countries, Ghana, like Mozambique, the actual and the forecast, it is not good. So these are debt to GDP ratios, which are also expected not to be good by the latest 2021 African Economic Outlook. So it is consistent with that. So let's discuss the key elements of the 2019 Economic Report on Africa, which is going to be on date for this topic. And I also encourage you to supplement your understanding by making some readings and developments since the publication of ERA 2019, as I was alluding to some of them. So the starting point is Agenda 2063 or the Sustainable Development Goals 2030. Africa's roadmap for development is articulated in Agenda 2063. Leaders committed to reduce unsustainable levels of debt and to domestic resource mobilization. This has been crafted much earlier than COVID, and they really pointed to the right problems that African governments have. In the past, Africa benefited from global debt reduction initiatives, and it will no longer be accessing that now because under HIPC and the multilateral debt restructuring initiative, it was much more easier to deal with restructuring and forgiveness because of the sources. Now the sources are changing. As I told you, private creditors, commercial banks, and the issuance of Eurobonds has really changed the composition of Africa debt. So when you are negotiating, you are not negotiating with only public, bilateral, and multilateral organizations. You have to really bring in the private sector. And to put it into perspective, the proportion of debt that Africa is owing to private creditors on average right now as it stands is 40%. So that is very high. And the repayment rate of those non-concessional lending is very expensive. Therefore, even if it is 40% of the total on average, when you factor in repayments, it might be even higher than that proportion. Growth remains largely unchanged in Africa, but the outlook is gloomy under COVID-19. Yes, it was in 2020, but we are forecasting we will have a rebound. But I think over this weekend, I'm hearing that the new variants, particularly the UK variant, is leading to higher levels of infection in the continental Europe, and therefore the struggle and also the trauma, the economic as well as the health trauma that we are going to face through this COVID-19 pandemic is going to be with us for some time. So the gross figures, even if I gave you the positive rate of 3.4% on average for Africa, it may not be the right one because depending on the changing circumstances due to the pandemic and other exogenous changes globally, we have to make a revision of that figure. Weak global economy so far, monetary tightening, weather-related shocks, and security concerns in some countries remain a challenge. Yeah, very stable countries like Ethiopia are now unstable, and Sudan, South Sudan, has never been stable, and we have a lot of some downward trends or symptoms of downward trends going on. Public debt rose in Africa in 2017, reaching 59.1%, and experts argue whether it is 59 or 60, but I don't think it does matter. Now we know that it is even much higher. It is between 70 to 75%, especially by the end of 2021. We expect that to be the reality. And many countries are making deals and also negotiating their debt contracts with their creditors behind doors. And we will find out what outcomes have been gained through those negotiations. The high and rising debt credits created debt vulnerabilities for many African countries. About 40% of low-income countries now face debt servicing challenges. And this is the reality before 2019 Economic Report on Africa was published. That is like 2018. Now the percentage is much higher. an increasing number of countries are at high risk of debt distress or debt distress, and this is rising debt sustainability issues. And this is the reality even for Zambia, and Zambia was just simply a high-risk country by the time that ERA was published. But today, after COVID, we know that in November last year, the country had defaulted. If you look at figures 7.2 and 7.3 of ERA 2019, there are about 16 countries in debt distress. And that has increased dramatically in recent years. So it is a complicated scene of debt by evolving changes in the source of debt, some of which are on high interest commercial rates from non-concessional sources. The challenging pattern of external borrowing helped to explain Africa's rising external debt. They started to diversify the source and the composition, and this is summarized in figure 7.4. So this really reinforces what I have already said. And the creditors are not the usual conventional Paris Club official bilateral creditors, because the non-Paris Club non-official creditor, which is bilateral, you know it very well, is China. And in addition to that, we have commercial banks, we have the private capital markets where Eurobonds are issued. So we have new players coming into the scene. And proportionally, the share of concessional lending is falling. So now both bilateral and commercial creditors are featuring more prominently. Domestic borrowing, particularly I was mentioning about development banks. Usually development banks in different countries are interfered by politicians if you have a development bank in a given country. Why? Because they are used as a vehicle whereby governments borrow at lower interest rates from the central banks. So the public domestic debt is also important. It is not only external debt that we should be worrying. The recent expansion in domestic borrowing in Africa reflects efforts in the middle-income countries such as Egypt, Ghana, Kenya, Morocco, Nigeria, and South Africa to develop domestic debt markets to mobilize resources through bond issuance, improve financial sector development, and deepen financial markets. Governments introduced securitized instruments such as treasury bills and bonds in the late 1990s and early 2000s to mobilize domestic resources and finance their fiscal deficit in the face of declining external assistance, and it is wise. International bond issuance increases in major African countries, and this has been also a big challenge for countries such as Zambia that we mentioned. There has also been a rise in local currency denominated bond issuance, and South Africa is a single case country which is usually pressed for that, and most of its debt is denominated in rand, in domestic currency. And there is the debate, and the jury is out there whether you have to develop this in future across many countries so that you can really hold your debt in local denominated currencies. This is driven by the desire of some African governments and public sector entities to develop their domestic bond markets. I think I cite South Africa as the most developed one, and meet demand from investors for low volatility government, municipal, corporate, and diaspora bonds. What are the challenges for local currency bond markets? African governments view local currency bond markets as an effective means to mobilize alternative sources of finance. And this has been discussed actually when I attended a meeting of Financing for Development, which was held, a global meeting actually held on the back of just before agreeing the Sustainable Development Goals of 2030. And the meeting took place in July in Addis in 2015. And alternative sources of finance were being discussed, and there were a lot of side events focusing on that. Actually, some of them focusing on innovative source of finance. And I think countries have backtracked on those commitments. Otherwise, we could have been in a better place when it comes to the debt situation. Because those side events and also the political commitments, experts, the finance ministers, they were discussing that we shouldn't really always rely on foreign aid, foreign rescuers when we are really struggling for a better fiscal space for our development needs. So that is a good set of discussions which were not really backed by practice. If they were backed by practice by now, we could have had a better scenario of debt management. However, to ensure sustainable development and deepening the local currency bond markets, countries must address a range of challenges such as weak legal, regulatory and institutional frameworks. This has been said many, many times. Sometimes it is really ironic. Governments always make speeches saying that, oh, we have poor institutions, and they have very limited practical steps taken to show for it, so that they make some progress in terms of governance and improving the quality of institutions. We have underdeveloped secondary markets, illiquid debt instruments, short maturities, and restricted and undifferentiated investor base. And I think you need a very, very committed, good army of economists, civil servants, public policymakers, lawyers, to really work in tandem so that there is a long-term strategy which tackles all these local currency bond market challenges and in general institutional quality in a given country. Sound macroeconomic environment. Actually, since the turn of the century, Africa has done better in that regard. Before that, we cannot blame Africa altogether because a lot of complex negotiations took place with the Bretton Woods institutions such as IMF and World Bank, who were pushing for fast liberalization of trade and finance and privatization of state-owned enterprises. And that really didn't go well because economies suffered. So the macroeconomic mismanagement before that was also facilitated by poor macroeconomic advice from Washington. And they just give his advice even without traveling to Africa. So that was really a disaster. So that is in reference to the structural adjustment program, which you might be well aware of in the 1980s, late 1980s and in the early 1990s. Moreover, harmonizing the legal and regulatory framework, improving the rule of law, and facilitating cross-listing of bonds on several exchanges will help create scale economies and deepen local currency bond markets. I think the implementation of the African Continental Free Trade Area will develop to help to solve these challenges, because particularly in phase 2 of the implementation of the free trade area, capital market development is emphasized. And I expect that this cross-listing of bonds on several exchanges and several countries coordinating might help to solve the challenges. But this is in the long run. So given the diverse debt sources, debt servicing, not serving, but servicing is rising. Due to globalization, use of short-term traded credits expanded. Sometimes some of the trade credits are given to you by those creditors who helped you to restructure your debt. And the revolving door idea comes from that. But I will devote another session, particularly when we discuss technical issues on the live webinar about the revolving door. So they restructure your debt, but they tell you where to get the loan from. So then again, you will develop another form of debt from their chosen creditor. So use of short-term trade credits expansion was usually facilitated through those tricky restructuring and rescheduling discussions between a very poor, powerless debtor and a very powerful creditor, which has negotiating power and also the power to make suggestions whereby the poor countries have very limited choice except accepting it. The accumulation of debt, the high debt servicing, and the subsequent distress led to restructuring of debt in some countries. Yeah, and we know that Mauritania and Ethiopia have done already, at least with some of their bilateral lenders. Several factors have made debt servicing by African governments more difficult, including slowing economic growth. COVID made it worse. Deteriorating terms of trade, yes. COVID even made commodity prices worse, even if commodity prices historically are well known to be volatile. Loosening fiscal policies, particularly reckless spending without good fiscal prudence, particularly for some countries. A re-evaluation of cross-border risks in international financial markets. And part of this difficulty might be resolved through the AFCFTA, which we believe is a game changer. So we have to really look towards a solution. And even when I'm going to discuss on the webinar next week, I will focus on solutions, because it's not really helpful to say we are in debt, our debt is unsustainable, and so on. So what can we do in terms of solutions? I'm sorry. Okay, sorry, let me continue discussing the recommendations. Sorry for the interruption of the telephone while I was discussing the need for a resolution and also thinking about solutions when it comes to the debt and unsustainability of debt. To prevent fiscal and debt position from deteriorating, there are actions that African governments can take. One, they should rebalance their policy framework to maintain stable income and expenditure flows for achieving sustainable development goals. This is a loaded sentence, but at the same time, very important. And if this basic principle has been followed, we could have avoided a lot of deficit either from the capital account side or the current account side or fiscal deficit in general. So the resource mobilization by African governments themselves is no-brainer, and we have to really pursue it. I say this because we know when we look at the trends of overseas development assistance flows, it is declining. Therefore, Africa should really rise up to the challenge. And we were also registering positive growth for the last 20 years. Therefore, the developed world expects, okay, now you are growing, therefore you have to raise your own resources to manage your own expenditure. So I think living within our budgets and living within our domestic resource mobilization opportunities is what we should really always be reminded of. In terms of the sustainable development goals, for sure, we are not going to achieve goal 1, for instance, reducing poverty by half or inequality by half or eradicating extreme poverty. Actually, more and more people are being pushed towards poverty. Already in 2020, about 30 million Africans have been pushed towards poverty. So the likelihood of others being pushed into poverty is also rising. Therefore, let's forget it. SDGs, we have to reset the target and we are not going to achieve it. And that is a plain truth that we should really be accepting. Unless otherwise we have these first principles of living with our own means and also providing the fair sources of income that can really finance very wise, carefully and strategically selected expenditure items. So we have to really manage our budgets well. That's why countries such as Zambia are defaulting. We have to improve the quality of institutions and the quality of our manpower. I was telling you about development banks. Usually projects are not carefully selected because we don't have the skills in the different banks that we have. Development banks are one. So the institutional capacity, the human capacity, the skill capacity of institutions, and the way the bureaucracy works, or the way the government bureaucracy works, should be based on very high-skilled bureaucrats, very high-skilled technocrats, very high-skilled negotiators and politicians. And how many countries do have these sorts of good quality human and institutional arrangements? And not many. We have to use the skills to conduct more effective assessment of risks, even before debt sustainability issues have become very, very glaringly clear. So we have to really make this regular. And we have to choose public borrowing for long-term development infrastructure projects because they pay back. And that really is cost effective. And still, we still should continue borrowing, but at the same time, we should really put it into good use. All this discussion of debt sustainability is not to discourage countries from borrowing. It is to say that borrow, but use it for good use and long-term economic development so that the future generation is not going to be faced by excessive debt. The material that you see from now is supplementary material. And it compares the current reality of African debt with what was the experience 5 years ago. So it will give you the scenario of what we were witnessing 5 years ago and how it was growing. And this is just to show the effect of China, particularly when China suffers, the slowdown also remains a risk to Africa. So this is one UNCTAD statistics, which shows you the total exports to China, GDP growth of China, and the composition of commodity exports to China. Trends in African debt, quite muted until 2014, but we know that after 2010-11 period, we have a slightly increasing external debt, both as a proportion of GDP and as a proportion of exports. But particularly, we have to keep an eye on the debt service as a proportion of exports because the foreign exchange that we get from the exports is the one which is servicing. And it was showing also the situation from an older data, the composition of the multilateral debt. Okay, the net debt of Africa has increased even when we were talking using data from the Economist or European Institute and the ECS calculation based on the Economist Intelligence Unit by resource orientation and also sub-region of Africa. The South and East have quite substantial debt of any sort for the 3 years that were examined. Okay, debt and growth in Africa. This, I just mentioned it, how you can handle it in a regression setup earlier. So we need to grow at double digits with large financing gaps to achieve the Sustainable Development Goals by 2030. Our publication in African Development Review, this is one of the internationally peer-reviewed journals, showed that Africa should really always grow at double digits if it wants really achieve Sustainable Development Goal 1, which is focusing on inequality and poverty. According to our calculation, it needs 70 billion US dollars per year for climate change adaptation and mitigation. And the responsible borrowing in the next 15 years and beyond is required to achieve the agreed SDGs. And this is standing at the point of 2015. And when we look at what COVID has brought and what all those debts, unsustainable debts have brought, it feels like we are really beyond unsustainable when it comes to achieving some of the targets that we set in development terms. So we have high growth, which was fueling our debt, but there are also the trauma, the economic trauma that follows COVID now adding into the pressure when it comes to debt. Okay, this is just a very good statistics when it comes to debt to GDP ratio, which dropped from 53 to 23% in 2004. It is incredible now. We are at a point whereby the ratio is at least 3 times higher than this, because we are in the range of 70 to 75% of GDP. And this is really worrying. Even at the point of 2014, we had net debt for Africa growing. So for sure, there are heterogeneities across countries. Not all countries are in high distress, and some central banks and finance ministers are managing well. But if you take the average African continent, it is clear that it is unsustainable. And the African Development Bank is asking for money, and it is not getting it from the donors. So we have a huge problem. And we had a very nice time in 2014, 2015. Okay, I will not go into the different sources because some of the figures, tables, and charts that I showed you already showed us the proportion of debt coming from different lenders. For some countries, even the private lending become 50% of the total external outstanding debt. That is huge. And sovereign bonds are issued, and they reached 90 billion in 2018 from 18 billion in 2004, or only 1 billion in 2008. So you can really see that the higher these sovereign bonds, the higher the external debt accumulation, the higher likelihood of default, and the higher likelihood of distress follows from that. So some of the macroeconomic determinants, as economists, we want to really see the channels through which we are accumulating debt and how we arrived at the current state of affairs. Research that we have done on growth regimes by classifying countries in different growth sections or regimes within Africa shows that commodity prices are very, very important. For instance, the volatility of the commodity prices is associated with our debt problem a lot, but at the same time, it's not only the volatility. The volatility is usually having a downward trend. Currently, we are happy because resource prices are rising, but under COVID, it was much, much worse. But recently, in recent weeks, I think we are at the cusp of the last commodities super cycle. If we don't take advantage of the proceeds that we get from these higher commodity prices right now, our debt situation will be even dire, more dire than what I tried to explain in this module. Declining commodity prices reduce debt repayment capacity and the ability to borrow. They also lead to fiscal unsustainability or weak fiscal space. And that should be enhanced with sufficient domestic resource mobilization efforts. So for commodity importers, maybe high commodity prices are not good, like resource-poor countries like Ethiopia and Rwanda. But for much of the resource-rich economies, it is a welcome news. So it is a double whammy for those resource-poor countries. They don't have commodity earnings, and they cannot take advantage of the commodity super cycle. But at the same time, they have to still keep paying their debts and the expensive repayments. And what else contributes to that unsustainability? Interest rate rises in developed countries, and particularly when you have a poor rating followed by borrowing from the capital markets, you end up having a huge bill in terms of interest rate payments. Even the servicing is unmanageable, let alone the principal. So interest rate increases can also reduce risk appetite for investors. For Africa, this might mean a decline in FDI flows and limited GDP growth. And currently, interest rates are lower in much of the developed world, thanks to COVID. But at the same time, if we are downgraded already, the capital markets are maybe willing to lend us, but at very, very high rates. So the doors are not as, or the way to gain more debt from external sources to finance the current pressures that we are feeling at home might not be that easy, even if interest rates right now are much, much lower in advanced economies. And we are holding our debt in dollar denominations. Third, increases in government expenditure, particularly borrowing from concessional as well as non-concessional loans, unmatched by government revenue. Again, this is pointing to the public finance management. Again, spend, but spend well in growth enhancing sectors so that you can really repay. Exchange rate risks are there. Usually they follow a rise in interest rates. Depreciation of African currencies induced by monetary tightening. I know at least 2 or 3 countries which are devaluing their currencies from time to time. And currently Ethiopia is also on the trajectory of dramatic depreciation of its currency after its decision to devalue the Ethiopian birr. So these are exchange rate risks which can really make the debt levels that you hold unbearable. So that is leading to debt unsustainability. And it's not only some countries, but overall, when we look at the average, according to the 2021 African Economic Outlook, African debt is unsustainable. And there is that reality that we should always sleep with and also try to come up with resolutions as quickly as possible. Other developments in other parts of the planet are also important. Due to Brexit, for instance, and because UK is out of the European Union, and other global economic dynamics, such as the US dollar is getting stronger, and this worsens the debt service payments for African countries. Yesterday's rate indicates that, 2 days ago, the US dollar was rising against major currencies such as the euro and pound sterling. So what can we say about debt management? Now, developing, and I'm reinforcing what I have said already. The note says as follows: developing and maintaining strong institutions and sound macro policies. So we have to really go through a series of discussions and also revisions of our macroeconomic management policies. Prepare bankable projects with return or positive returns after investment, and that will help us really to repay our debt. Reduce heavy reliance on commodity exports, but this is not easy because diversification of economic structures so that the relative importance of resources declines as opposed to the relative importance of some long-term or long-range securing sectors of the economy is a long-term commitment. It is not that easy. But if countries don't move in the direction of diversifying their economies and diversifying their revenue sources, they will not be able to manage the debt. Africa is going to grow at a very reasonable rate, which is very, very useful compared to global averages. We are higher 3.4, for instance, forecast for 2021 is much higher than the forecast for major economies. And that is a positive news. There are increasing financial needs for its development plans and visions, and that is where the problem lies. On the one hand, you have it unsustainability. On the other hand, you have huge development needs, in addition to supporting our society from collapse due to unemployment and unbearable price rises. Both internal and external macroeconomic factors determine the outlook of Africa's debt sustainability. For sure, Africa's debt sustainability outlook are uncertain and is getting worse. And this is what we know in 2016, and this is the reality today in 2021. So it is a very huge, urgent problem. Some key elements of the African economic outlook, I have discussed a little bit of the content in the context of this module at the beginning, and I just summarize some of them here before we conclude. And I have told you most of them because African governments need an additional gross financing of about 154 billion to respond to the COVID-19 crisis. 154 billion. So that is huge. And the debt to GDP ratio, by now you should really remember it. It is going to rise by at least a factor of 15 from its level of 60% in 2020 to a level which is much higher for a developing economy or an emerging economy characterized by the African economies that we know, 70 to 75%. Governments are asking for debt restructuring and rescheduling, and if there is any, it should be with a view to boost growth and recover from the economic trauma of COVID. And it is not really to encourage excesses, particularly in countries where institutions are weak, and this is many countries in Africa, and it is a truth in many of the institutional setups within the continent. In the current international economic order, there is no bankruptcy law for national or sovereign debt, or when countries suffer from unbearable, unsustainable debt levels, unlike debt to private individuals and firms. I think if you want to read more about the insolvency law for sovereign debt, Amerolo's 2015 article is very interesting. So hence African governments are at a high risk of exposure to vulture funds because we don't have bankruptcy law. So you can see the weakness in the international financial architecture, which is really rigged against the poor, and our continent is poor. And finally, the international financial architecture, we were teaching it in development finance for decades, and there was a call for a multilateral, coordinated, cooperating international community to come and craft a framework of really having an orderly exit from debt crisis, because we will face them in the future too. We faced them since the 1970s. Unfortunately, because of the composition of the stakeholders, as I told you, we have bilateral public lenders, we have multilateral public lenders like IMF and the World Bank and African Development Bank and Asian Development Bank and the Inter-American Development Bank for the Latin American bloc. We have private creditors, commercial creditors, and we have capital markets. And bringing them together on one table and having an orderly resolution of the debt crisis has proved to be very difficult. Still, we didn't lose hope, and it has continued now. There are a lot of efforts to really bring some form of an internationally agreed financial architecture. So far, history tells us it is not happening. There is a lot of talk about it, but we never managed to have a binding international framework with principles for orderly resolution when there is a debt crisis. For instance, if you have the private sector involved in this international financial architecture negotiation, the private sector want to know before considering restructuring and rescheduling for any given debtor country to know the debt contract that that country has with a bilateral lender. For instance, a private creditor may want what debt contract you have with China. If there is lack of transparency, as we have witnessed in many researches in the past, and also in reality, and this is the case that debt transparency is a huge problem, there is limited success in the negotiation around that table with a private creditor to really get anywhere in terms of getting a restructured arrangement to resolve the debt problems that you have. Because the private creditor might feel, okay, if I restructure or forgive a portion of this debt from country A might use the money to repay another lender, and for which the private lender doesn't have any knowledge of in terms of the details that the country A has with that bilateral lender. Let's call it China, because obviously China is lending a lot of African governments, and there is lack of transparency in terms of the debt contract that it has. So the future of having a binding international financial architecture or a multilateral international financial architecture is very limited. The chance of having one is very limited. So with that, I will conclude the debt and sustainability. And I will have a debt and debt sustainability webinar next week with you to discuss further some technical papers and also technical contents, but with a focus on what solutions that we can have. That's why I focused on getting together around the table with a binding international framework to really help poor countries. That's why I was focusing on how countries also internally manage their economies better to really not be in this situation of revolving debt crisis. With that, I will conclude my session, and I wish you good luck with the study, and I wish you also a very good weekend.